Hello and welcome to this week's edition of Econoday Unplugged. It's Wednesday, the 8th of July 2020. Mark Pender is stateside, Brian Jackson's in Sydney, and I'm Jeremy Hawkins here in London. In Hong Kong, China's hardline security law came into effect last week. The US subsequently announced it would revoke Hong Kong's special trading status, while the UK, which described the move as a clear and serious breach of a 1985 handover agreement, has offered citizenship to some 3 million Hong Kong residents. Tensions between China and the West continue to build, adding another unwanted layer of uncertainty to the already clouded outlook for global trade caused by COVID-19. For Hong Kong, which last year almost overtook Singapore as the world's third largest foreign exchange trading centre, there are now doubts about the sustainability of its status as a major international financial hub. It's always been a gateway between the East and the West, but might it now just become a home for wealthy Chinese investors? Is Beijing's move just something that will blow over, or could it have much more serious longer-term implications? Brian, what's the feeling in your part of the world?
There's a lot of concern, here in Australia and elsewhere in the region about what the long-term implications of this are. But it is very early in the process, so it's still hard to be definitive about just what Beijing's long-term intentions are, whether they're using this opportunity to try and tighten its control, given that the rest of the world is pretty much preoccupied with other problems, or whether that they still do see Hong Kong as a distinct part of the greater Chinese nation, and they want to maintain some sort of degree of distinctiveness. So it's very hard for anyone outside the state council in Beijing to really know what their long-term plans are. But what they've shown by introducing this new law is that they definitely do want to tighten things up, and it's going to be a rather difficult process for Hong Kong to try and adjust to.
So what do you think of the implications for business really in Hong Kong, these international businesses? I think you were talking the other day about this potential, not necessarily perhaps a wall of money, but funds coming in from mainland China into Hong Kong. Is that going to be sufficient that businesses will want to try and maintain a base there rather than perhaps just pulling out of Hong Kong altogether?
I think so. So I'm not 100% sure, but it's still going to have a lot of advantages, I think, for a lot of businesses to be there, to have access to the Chinese market, even if they do have concerns about, their own staff and their own companies being subject to this new law. There is still a big incentive to still be involved in Hong Kong, but there's no guarantee that you won't see some firms and some individuals think, well, this is there are other places we can do business in the region, and it might be worth considering that. So Singapore is the obvious example, and Hong Kong and Singapore have always sort of been in this sort of competition with each other, for many years now to attract talent and business, and so obviously this is something that Singapore might be able to take advantage of, and obviously the other. The other rival to Hong Kong's status as a big financial center is Shanghai over the last 10, 15 years, as China has relaxed some of the rules relating to financial firms doing business in China. You have seen Shanghai take up a bit of that role, but for the time being, I think a lot of businesses are still indicating that Hong Kong is still a very big part of their plans going forward. Maybe that's to make sure that they don't get on the wrong side of Beijing, but for the time being, the markets are definitely sort of suggesting that Hong Kong is still a place where they think it's important to be.
So I guess there's been no obvious signs of pressure on the Hong Kong dollar peg.
There has been. I think not necessarily relating to this development. There has definitely been a lot of flows in and out of Hong Kong that has put some pressure on that peg. But the Hong Kong authorities have shown, as they have for many years now, that they are able to defend those levels that they that they have marked down. So I don't think the Hong Kong peg is under a lot of pressure at the moment. But if things were to escalate, then obviously that would make it more difficult for them to keep the currency where they want it to be. But I think at the moment, right now, the focus of media attention is more on what this means for individual Hong Kongers. Whether it's going to significantly change the freedoms and the rights that they've enjoyed for a long time.
All interesting stuff. Watch this space, as they say. Okay, while we quickly stick with you then, rest of your part of sort of the world, anything else we should be aware of that's catching your eye or certainly of market interest at the moment?
Oh, I mean, obviously, it's, just looking at the economic data, I think the issue right now is, are we talking about growth rates or levels? So we've seen across most of the indicators that we track here, some signs of either stabilization or even recovery in some of the numbers, but we've got to also be aware that this is from very, very low levels after the sharp drop in activity that took place around February, March as the pandemic hit. So economies are sort of starting to get off the canvas, but they're still not anywhere near back to where they were at the start of the year in terms of the actual levels. And of course, all this has been predicated on improvements in public health conditions across these countries, and also on very strong stimulus from officials over the last few months. So if the public health conditions continue to improve, given that amount of stimulus that is in the system, you would expect to see further recovery and eventually a return to those pre-pandemic levels in activity. But it's a big if, obviously, that we won't have a second wave or a second sort of surge in cases across the region. We're already seeing in some parts of Asia and the Pacific area, some worrying signs that we might have a second wave, particularly here in Australia over the last week or so. We've had a big pickup in cases in Melbourne, the second biggest city here in Australia, and so that's threatening to derail the recovery that we've got here, and that could be played out in other parts of the region as well.
Okay, thank you very much for that, Mr. Pender. America's stock market's just had its best quarter in 20 years. What, the S&P was up 20% or so, something like that, remember, on the quarter? Yeah, the COVID numbers are going the wrong way. So what's going on?
A disconnect. I think it's the stimulus that and the hot money and the cheap funding that all the stimulus is providing financial firms, and they're pouring it into the stock market. Because if we're back at the levels that we were before the crisis, and the crisis is, whether or not the crisis is easing, that's another question. But the economy has changed with the virus, and it's hard to believe that output will be and profitability will be unchanged as it from in this post world. Certainly, there's so much stimulus, as Brian was talking about, already in the cake that there is probably a good chance of continued gains, maybe more in the financial markets than in the actual economy. It's a very difficult separation right now. It's not anything that the Fed yet says it's worried about, but it may come to that, because what we're talking about is financial stability, and that's a very important thing, and it's their third foundation, their third pillar of policy. And if they're feeding an asset bubble, another trouble there would make this whole would add another level of crisis to the crisis.
Okay, let me ask you about if I can, the employment report from last week, which
Okay.
almost people have almost seemed to have forgotten about that now. There's so much else going on, particularly the likes of China and Hong Kong and so on all the politics. Now,
Yeah.
superficially again, another strong report, but you, I think, still have your doubts, don't you, about just how these numbers are put together, or at least how they're identifying different brackets of the employment or unemployment report itself.
Yes, don't think that there's any doubt that there's a gigantic job creation going on. The June report came in at 4.8 million payroll jobs. It's new payroll jobs, and that follows 2.7 million in May. Of course, now it plunged in April, so in March. But what's also going on, today's Wednesday, tomorrow's Thursday morning, we're going to once again get jobless claims. What's also going on is a tremendous amount of job destruction. At the same time, we're getting new creation. And this is picked up not only anecdotally, but also within the statistical reports themselves, which are warning to a greater degree that businesses are closing, which affects their sample size in a specific way. But it also reflects the fact that this crisis the economic changes that it's bringing about are still have very strong negative impacts. And so is the worst behind for employment? Certainly employment now is one of the big pluses for the U.S. economy, at least in its degree of recovery. So even though it's below the levels it was, of course, before, as Brian was mentioning, all the levels are lower than they were in February. But the growth is very, very strong. How long can that continue with all this stimulus? I don't know. But what the stimulus can't do is specifically it's apart from the actual changes in production and delivery of goods and services. And that's going under some kind of a metamorphosis right now. And part of that metamorphosis is some places gaining jobs, perhaps online, and other places losing jobs, forward-facing services.
Yeah, interesting times. The whole structure of these economies seems to be rapidly changing, doesn't it? At least perhaps
Yeah.
that's how they survive in the future.
Well, now
Okay.
let me ask you about
Yep.
Switzerland. Tell us about unemployment in Switzerland, if there is any.
Oh, so I'm not sure if I really want to, because it doesn't fit in with any of the stories we're talking about elsewhere, really. No, I mean, you're right to point it out. I mean, what we can say about Switzerland at the moment, certainly within the context of what's happening in continental Europe, is that it seems to be outperforming. So without, plug in too many numbers. We did, as you mentioned, we had the Swiss unemployment data out of Switzerland earlier on today. These were for June. I mean, previously, so for May, the seasonally adjusted unemployment rate was only at 3.4 anyway, which historically speaking is not particularly high for Switzerland, and clearly compared to most other countries is in fact extremely low. Expectations inevitably were that it would see a rise. We start to see the economy struggling under the weight of COVID-19, but it fell down to 3.3%. Now, okay, the actual number of unemployed did go up, but nonetheless, we've seen a significantly stronger in general than expected employment data for June. May retail sales are quite remarkable because we saw a surge there, and these are volume sales, not nominal sales, they're volume sales. And as of May, they're back above where they were in February before the coronavirus struck. So taken at face value, it would appear that the Swiss authorities have managed the coronavirus situation particularly well in Switzerland. It would appear to certainly to be the case that the hit to the economy wasn't as substantial as it was, let's say, in the likes of France or Spain or Italy. But nonetheless, so far for Switzerland, it looks as if the economy is outperforming. Now that's going to be interesting, I think, for the SNB. As we've talked about often on this podcast, they've been struggling for so long with the strength of the Swiss franc, and the problem for them could well be if we see COVID issues, returning, or the second wave, or call it what you will, in other countries in Europe or states or Asia. It could end up seeing additional capital inflows into the Swiss franc, which makes the Swiss franc even stronger. And as we've said before, the Swiss National Bank really doesn't want to cut interest rates any deeper into negative territory. So it certainly is an interesting one to watch, I think, at the moment, Switzerland. For the rest of Europe, however, things really aren't quite so good, I don't think. We have seen, if anything, I guess, some signs that demand, at least private sector demand, is picking up, as both yourself and Brian were saying, really from extremely low levels. So there's a long way to go yet, but signs of growth coming through there, but still a long way short of where we were in February time. Output, and there's limited output data available really for the Eurozone currently. That appears to be coming back much more slowly. And I think the idea of any kind of V-shaped recovery for the Eurozone still looks to be pretty unlikely at the moment. And prospects here really continue not to be helped by the stimulus side of things. I think Brian was mentioned about the stimulus in his part of the world. You're talking about all the stuff that's been thrown out into the states from, well, be it the Fed or particularly coming from the administration. But for Europe, there's still this kind of logjam in terms of getting this agreement, this coordinated agreement on what's going to happen on the fiscal front. So there's still no concrete settlement about what they're going to do in terms of this COVID rescue plan. They want to get this thing through. It's worth 750 billion euros. It needs to be allocated as quickly as possible, but as we speak at the moment, there's still disagreements about the overall size, how it's going to be allocated, who's going to pay for it. So it really does seem, if it's going to be delivered, it's going to be delivered, well, effectively too late for a lot of countries, which currently now maintains the onus on the poor old European Central Bank to come out and do whatever it can. There will be another ECB meeting Thursday week, so next Thursday, but really they've just come out and substantially eased monetary policy via their pandemic emergency fund, and it's hard to see them doing anything else. But I think you've got to think, if the European Commission side of things can't get their act together, then it's going to be monetary policy which will continue to bear the brunt of trying to get the Eurozone economy going again. What else from my side? I guess I could mention the UK. It's still question marks over just how the UK is going to perform during this process. I think the sense has been it's been hit partly amongst the hardest of the countries within Europe, and I suppose that's reflected in the announcement today we had from the Chancellor. He came out with a new summer statement, which is really built around trying to protect the labour market. So if it's fully used, and this package of measures includes a temporary cut in VAT on hospitality business, particularly aimed at tourism. So that's going to see the VAT rate down from 20% to 5%. Is given additional monies to try and help job retention once we see the furloughing scheme ending. There's other help coming for eating out. There's vouchers being provided to restaurants and things. So there's, all in all, it could amount to the best part of about 30 billion sterling or so if it were fully used. So it does highlight, certainly as far as the UK is concerned, government here is still throwing an awful lot of money at the UK economy, trying to turn it round. And again, I suppose for financial markets, that's important because it's not just COVID figures, which are worrying investors over here. It's Brexit. And Brexit talks last week, they broke up a day early. Both sides still a long way apart. So at this stage, it's anyone's guess as to whether or not we're going to get what we can call a soft Brexit. That is, if they can get a respectable trade deal between the two sides, or a hard Brexit whereby essentially the UK walks away without any deal whatsoever. So sterling likely to remain, well, really amongst the most volatile currencies, I think, within Europe at the moment.
And Jeremy, just across Europe, is there a general sense that at least the COVID is tracking the right way, or are there some worrying signs that we might have a renewal of concerns about the disease in some parts of the area?
Think in some ways, I think the Europe is kind of tracking Aussie a little bit, in a sense. I know you've got the problems in Melbourne at the moment, but as I understand it, that's kind of it, isn't it? I think for your part of the world, at least for Australia.
At the moment,
yeah. Well, I think for Europe, there have been some relatively small local outbreaks in Spain, Germany, and also the Balkans, but there haven't really been any sort of major setbacks since they started easing restrictions. And looking at the broader COVID numbers, then without wishing to tempt fate, they're all kind of heading in the right direction at the moment. So I think with a general sense that so long as they can manage any kind of second wave, then okay, Europe's going to struggle like the rest of the world, but unlike some parts of the global economy, the COVID numbers at least may not be the big problem they could be elsewhere. So,
Jeremy, could they be a problem in the UK? We had some spotty reopenings here with lots of leisure and hospitality in restaurants in certain states, and we're seeing an alarming spike going on in those. And the pictures they're sending around on the when you guys went to the pubs the other day, you guys were packing them in. So I mean, what is? I think health authorities say about that?
Well, I think to be fair, I mean, as they say, sex sells. So I think it's, the photographs which made the media were those places where they, as you say, they were packing them in. The idea of social distancing went completely out the window. Some pubs had to shut early. But on average, I think the response from the would-be pub goer is that they're not completely convinced it's safe to go back to the pub yet in the first place. And this, to be honest, is one of the issues for the hospitality industry in general. And while, as I mentioned, the Chancellor's just come out and given these 50% off vouchers for August to encourage consumers to go back to restaurants and the like just to spend some money. So I think, but the broader picture, I think you're exactly right. At this stage, until you really see the implications of the gradual withdrawal, or let alone the complete withdrawal of all these COVID restrictions, then you're simply not going to know whether the COVID's been addressed properly or there's some second wave, in which case, well, we'll just have to wait to see what on earth happens about that. So I think it is one of these things, yes, for the UK and Europe on the whole, it's good news in the sense that the directions is going the right way, but that may or may not be a short run thing. Okay, right. Anyone for anything else? Okay, good. In which case, thank you all very much for listening. That is it for today. We'll be back next week. But in the meantime, remember, you can keep up to date with all the key market moving data and events in Econoday's global economic calendar. So from Mark, Brian and myself, thanks as ever for listening. Stay safe and we'll see you next time. Bye for now.